Good afternoon, everyone, and thank you for joining us on today's webinar to discuss the current state of the energy market and to provide our outlook for MLPs. My name is Will Hershey of Yorkville Capital Management, and joining me today from Yorkville will be Darren Scheringa and Jim Hugg. If you have any questions during the course of the prepared presentation, please feel free to type them into the text box in the bottom right corner of your screen. We will hold a Q&A session at the end of the call, and we'll do our best to answer everyone's question. With that, I will turn the call over to Darren.
Thank you, Will, and thank you all for joining us for our second quarter call. I'm going to start by looking at the first quarter in review, so the first quarter of 2016 and what happened both fundamentally as well as from a price performance in MLPs. If you look at the first slide, we really want to address the myth and hopefully dispel this myth that prices going down mean fundamentals must be deteriorating. And generally speaking, that would be true, and most of the times that is the conventional wisdom. But what we find in MLPs and what this slide looks at, we're focusing again on infrastructure MLPs here. And infrastructure MLPs, as we've said on numerous calls before, are the pipelines. And pipelines, I'm simplifying it, but for our purposes here it works, least capacity on their pipelines under contracts, generally speaking longer term or long-term contracts, and have very little direct commodity exposure. And if you look at infrastructure MLPs in the first quarter, Yorkville created 2 scores to help investors and asset allocators look at the overall health of the asset class. And the first one is the Yorkville Stability Score. And the score of 10 is a perfect score. It means 100% of all partnerships maintained or increased their distributions. So for infrastructure MLPs, which represent 90% of the asset class by market capitalization today, 9.8, so 98% maintained or increased their distributions in the first quarter of 2016. The second score that we created was the Yorkville Growth Score. And the growth score represents the intrinsic growth of the underlying partnership. So what are the assets actually producing in terms of cash flow that investors receive, and how much did they grow on a year-over-year basis? The Yorkville Growth Score for infrastructure MLPs in the fourth quarter was 9.7%. That means on average, infrastructure MLPs grew their distributions by almost 10% on a year-over-year basis in the first quarter. So clearly, any company that is able to grow its cash flow fundamentally from its operations by 10% is not a distressed company, but is a healthy company. Now, looking at the second part of the equation, if we look at price performance of MLPs, which this next bar chart shows asset class performance in the first quarter of 2006, MLPs for the quarter were down 6%. And clearly, 6% is very different than all of the other asset classes we compare it to on this chart: utilities, REITs, 10-year treasuries, high-yield bonds, and then the S&P 500 index. MLPs were the only asset class to show negative performance in the first quarter. What the 6% hides is the fact that volatility that MLPs experienced in the first 2 months of 2016. There was a double bottom, which means MLPs tested a low twice in January and then again on February 11th. And during those bottoming processes, MLPs in January dropped 28% intra-month. And then again in February, MLPs pulled back another 20%, so they went up and then they dropped down again. They went up and they dropped down again, to what now has been, and we think will be, the ultimate low of what we're calling the great energy recession of 2015, which will be the February 11th low. So the volatility in MLPs, not only have they underperformed other asset classes, but the volatility in MLPs spiked in the first couple of months of 2016. What we've seen since then, and it's a very good sign, is volatility is compressed. And what volatility compression means is that the amount of intraday swings, positive and negative, has come down. So there's more stability in the price movements of MLPs on a daily basis. Generally, when you see volatility spike, it's indicative of a transition period, either from lows to highs or highs to lows. As it compresses, MLPs are starting on a new trend line. The trend line we've seen since the bottom is MLPs are trending upwards, and we believe that is the accurate and most reasonable trend line given the fundamentals, which we'll discuss in a moment. What happens when distributions or income remain stable, or in fact, in the case of infrastructure MLPs, grows by almost 10% year over year, and prices come down, yields increase. During the first quarter of 2016, MLPs almost, during one of these pullbacks and on their February 11th bottom, were almost reached historic high yields. And what that means, if you look at it relative to normal equities, would be the S&P 500 trading at a price-earnings multiple of 5. MLPs on a yield basis, which is a better metric for valuing MLPs, almost reach the equivalent of the S&P trading at 5 during its February 11th low. When you look at, not only is that a great entry point, or historically has been a great entry point, either to buy the S&P 500 when equities are that cheap, or in this case of MLPs, to buy MLPs when they're trading at these valuation ranges, any asset class bought for deep discounts generally becomes a good entry point from an investor's standpoint or perspective, but also on a relative basis, as yields have increased for MLPs and remain elevated above historical averages at the end of the first quarter. You can see here commodity MLPs were yielding 10.6%. Infrastructure MLPs, the third line down, are yielding 8.1%. Across the asset class, yields were around 9%, finishing the first quarter of 2016. 9% yields, given the stability of distributions that we've seen in MLPs to date, 9% are, on an absolute basis, are pretty much unmatched globally, given quantitative easing going on around the rest of the world. We have seen, and we believe that one of our statements that we've made to investors as we've been speaking to them, these elevated yield levels, not only are they a great entry point from a valuation perspective, but for investors looking for yield. This yield will start to bring a new investor base into the MLP asset class. We've seen that in the first quarter of the year. Even with the volatility in January and February, fund flows have been extremely strong. In fact, on certain weeks and months, we've seen record levels of inflows into MLP funds in 2016. So the yield is attracting a new investor base, which is very important. Generally, after investors have experienced a money-losing experience like they had from 2014, 2015 to the beginning of 2016, the investor base generally turns over and new investors come in who see opportunity now in the asset class. So, in summary, the first quarter, MLPs traded off 6% for the quarter, which really masked the amount of volatility that the asset class experienced. There were two bottoms. The first in January and then a second in February, both north of 20% pullbacks from highs made. We've seen volatility compress recently, and the yields right now is sitting at or spiking at 9% at the end of the first quarter are extremely attractive on a global basis, and that's led to record inflows into the MLP asset class, which ultimately bodes well for price performance going forward. So, and then finally, a decoupling MLP income. When you look at infrastructure MLPs, again, 90% of the market capitalization is infrastructure. That, again, you had 9.7% growth rates, and 98% of all MLPs maintained, infrastructure MLPs maintained or increased their distribution. So, in summary, a disconnect between fundamentals, which remain strong, with cash flows growing, and price performance, which, again, traded off. So what's our outlook for 2016, and how should you look at it as investors who are either considering getting in or investors that have felt the pain of the most recent pullback? If 2015 felt bad, it really was bad. It was the worst period on record for MLPs. The nearest example we had was the financial crisis of 2008, which turned into the Great Recession, the Great Global Recession. As you can see, the green line, which represents the most recent pullback, is strikingly similar on the downside to the 2008 financial crisis. The difference I'd like to point out, it actually goes a little lower. So from peak to trough, this time MLPs pull back almost 60%. Last time it was just a little over 50%. Either or, it's catastrophic in terms of drawdowns in both 08 and again in the great energy recession of 2015. You can see since the lows reached on February 11th, MLPs have turned over and are beginning a recovery that we believe is based on fundamentals improving, and we'll discuss that on the next couple of slides. So the takeaway from this slide, if 2015 felt bad, it was the worst period on record for MLPs, but we believe the bottom was put in on February 11th of this year. The term, the Great Energy Recession, we believe is appropriate because what MLPs and what oil experienced last year and commodities more generally was a catastrophic event similar for the energy industry and asset class that the entire global economy experienced in 2008. And what did we learn in 2008? In 2008, all risk assets, their correlations spiked. The correlations spiked not because the assets moved up, but because they all moved down together. And what we experienced in 2015, and it was the same thing, but it was limited in this case to one sector of the economy, the energy sector, is that energy equities, energy fixed income, and the commodity prices all came together and dropped dramatically over the course of 2015. So you see WTI, which is West Texas crude oil, it went from 105 at its peak and it dropped in 211, February 11th, the market low as well, 75% decline from peak to trough. So a catastrophic drawdown in the price of oil, similar in terms of magnitude to what oil dropped in 2008, except it went from 140 to the low 30s over that period of time, but a similar over 70% decline. The difference between 2008 and 2015, what caused oil to pull back 70% in each environment? In 2008, given it was a global recession, we had demand destruction. And on an absolute basis, it was a 4.5% demand destruction on a global basis, which was around 3.5 million barrels per day of demand that was destroyed during the Great Recession of 2008. What was different in 2014 and 2015 is that we had oversupply. So demand remained relatively healthy, and in fact in the U.S. demand was very robust because the price of gasoline came down and miles driven actually increased to record levels last year. So, but we had oversupply. Now if you look at the first bar chart here, global oil production, in 2011 it was 90 million barrels a day, and by 12/31/2014 it was 96.3 million barrels per day at its at peak. So growth of 6 million barrels over a 4-year time frame, really over a 3-year time frame. Where did this production increase come from? Well, 56% of it, almost 60% of the increase came from the United States. So over 3 million barrels of new production came online. It came online out of the United States. Where did it come from? Primarily from our shale plays. And what this is indicative of is the U.S. energy revolution. Over a short period of time, the U.S. has not only turned from declining production levels to increasing production levels, In the beginning of this year, a 40-year ban on exporting oil was lifted. We are now an exporting nation of oil as well. So the energy revolution, which really underpins the growth in production here and will be one of the greatest drivers of future demand and need for greater infrastructure as we continue to increase our production in the years going forward out of the United States, will drive more need for infrastructure, which will primarily be supplied by MLPs. So production growth came out of the United States. On the supply side, we were primarily the cause of the oversupply market, which caused oil to decline. The market is in the process of rebalancing. The first stage of a supply coming offline are rig counts, because you need to drill for new oil. The amount of drilling activity is reflective of what future production will look like out of any given field or area. In the United States, again, back to the peak in 6/30/2014 through 4/15 of this year, rig counts in the United States dropped from 1,800 to 400. It's a 77% decline in drilling activity in the United States over the last 2 years almost. These levels of rig counts are even below where we reached in the downturn of 2008. Rig counts are coming down. This is the beginning, again, indication of production coming down. Production levels in the United States, if you look at the next slide, have dropped from a peak of slightly under 9.7 million barrels per day reached last year. The most recent reading, we saw a decline of close to 700,000 barrels per day in the United States to a little below 9 million barrels, so 700,000 of the new supply that we brought online has come offline due to lack of drilling. The United States will be one of the primary balancers of the oversupplied markets in this year. We expect, and the forecasts are, that the United States production will come down another 400,000 to 500,000 barrels this year and be roughly 1 million barrels down from its peak production levels of 9.6 million barrels reached last year. So the 2 weekends ago, there was a lot of focus on the meeting between OPEC countries and Saudi Arabia and Russia and Qatar. The Doha meeting, as it's been called, and that's where it took place. The focus was on a production freeze. The meeting ran 10 hours overtime, and the production freeze didn't happen. There was nothing signed as a result of the meeting. Prior to the meeting, we were asked, is it important, the production freeze? And we said, to a large degree, it's meaningless. The markets are organically balancing themselves right now. A big part of that is the United States production levels are dropping. And again, we quantified that a moment ago by 700,000 barrels per day currently. So if you look at this slide here, this is taking a look at, on a global basis, the market supply and demand, and currently we're oversupplied at year end, and these numbers come from different sources, but roughly 2 million barrels of oversupply. At the end of the first quarter, we were oversupplied globally by roughly 1.5 million barrels. That's a 25% reduction in the oversupply. So the oil markets on a global basis are in the process of a natural correction. The other reason that the freeze was not that meaningful was that most countries, most OPEC countries, are producing at maximum levels right now. They didn't really have the ability to add a lot more production, and so to freeze at maximum levels of production is not really doing that much. And so, as we can see, again, oversupply from 2 million at the end of the year has dropped by 25% in 3 months. The balancing of the oil markets will take place in the second half of 2016 and into the beginning of 2017. If we had to give and that's our base case scenario, that's sort of what the market participants are anticipating, A bull case scenario would be that you'd actually see supply come off a lot faster than the markets are anticipating due to underinvestment in drilling activity on a global basis and on infrastructure on a global basis. So we're not anticipating that. That's not part of our investment case for 2016. Anyway, the oversupply problem, which caused oil to drop, is naturally correcting itself, or organically correcting itself. West crude, again, when we look at it from the trough in February, is up over 50%. Today it's just shy of $45 a share. So oil prices are responding to a market coming back imbalanced. What we saw last night out of API were inventory drawdowns in the United States of 1 million barrels. The EIA numbers this morning contradicted that a little bit. The point being, ultimately, we're going to start to see inventory draws come down on a more regular basis. What we've seen over the past couple of years are inventory builds on a regular basis, and that will start to turn around as the market becomes, again, imbalanced, supply and demand imbalance. Anyway, if we stick to this argument, again, that the fundamentals, MLPs, due to the underlying business fundamentals of infrastructure MLPs, very low commodity exposure, really a leasing business model that is predicated on the lease multiplied by the lease rate over the number of years equals revenue, and there's no commodity input into that equation, so very little commodity exposure, that MLPs will decouple from the price of crude oil, but we needed crude oil to stabilize and stop dropping in order for MLPs to start to get to footing. So what we've seen when we look back to 2007, before the Great Recession, and you can see that here the crude oil spiked again at $140, the gray line, dropped to low 30s, and then it popped back up and sort of moved around in a range bound from $80 to $100 in that range from 2009 through 2014 after an initial spike. Look what happened with MLP prices. MLPs continued to appreciate from 2008, the bottom, moved up with oil. Oil didn't continue to move up. MLPs did continue to move up. We anticipate the same thing will happen in this market cycle. This is a decoupling of MLPs relative to the underlying commodity price. To quantify that, in 2009, investors that got in the asset class, but even more specifically looking at the the Yorkville MLP total return universe, which takes into 100% of all MLPs, so it's the best representation of what's going on with the entire asset class, because it is every MLP that is part of the entire population of MLPs. Between 2009 and 12/31/14, MLPs appreciated. $1 million investment grew to $4.1 million over that period of time. When you annualize that return, you're looking at a mid-20s type return. We believe that MLPs, given the valuation and the pullback they've experienced, are set up to enter into this type of outsized return level. We don't know what the numbers will look like, but given the parallels between 08 and current, we think this is the stage where we're at. And again, as you can see, last time it was a multi-year cycle, a 6-year cycle between trough to the peak of the market. So, in summary, 2015 was very bad. In fact, the Great Energy Recession was the worst period on record for MLPs in terms of price performance. Fundamentals for infrastructure MLPs through the first quarter of 16 remain very robust. 98% of all MLPs maintained or increased distributions, and distributions grew at just shy of 10% in the first quarter. clearly a disconnect between the fundamentals and the price of MLPs. As a result, yields have shot up, which make it the asset class very attractive to new investors, and we've seen a lot of investors move into MLPs in the first quarter of this year. Number two, the problem with oil being depressed is oversupply. We are witnessing the oil markets on a global basis organically come back into supply. The oversupply, 2 million barrels at the beginning of at the end of 12/31 and of last year. 3 months later, 500,000 barrels of oversupply has come offline, so 25% reduction. The primary area of the reduction is coming from non-OPEC countries, and again, primarily from the United States. And again, this morning's numbers out of EIA showed another 15,000 barrels per day decline in production out of the United States. So the supply problem is taking care of itself, and we've seen oil prices come up over 50% from their bottom. We need them to stabilize so that MLPs, again, can decouple from overall commodity prices. And that's where we believe we're set up in, again, is coming out of the bottom of 2008 into 2009. So how are we doing as a firm? The Yorkville MLP core income strategy for our investors here, or for investors considering to get into the asset class, and why MLPs. We hope we've made the case for them. Now, why Yorkville? The MLP core income strategy, we're delivering fundamental alpha. This is our quarterly report card. It's how Yorkville is doing for you. Our stability score, as you can see, it's 10, which means 100% of the names in our portfolio maintained or increased distributions. That is a record that we have are very proud of, and to the best of our knowledge, over a 16-year track record, which is one of the longest audited track records in the MLP asset class, or GIPS compliant track records, more specifically, is we haven't shown a distribution cut. And that's during the downturn of 2008, and again during the great energy recession of 2015. Our growth score, when you look at Yorkville, we are the growth managers in MLPs. We view MLP investing as really, it's a total return investment strategy. Income is great, but what's even more powerful is how fast the income is growing, because the growth of distributions ultimately drives price appreciation. So as you can see, our portfolio grew distributions, or the names in our portfolio grew distributions on average 13.1%. Mid-teen level growth in the first quarter. So clearly we're generating fundamental alpha over the broad market. Our current yield in the strategy is in line with the MLP Universe Index, 8.6%. The strategy is yielding 8.7%. Currently, generally speaking, over time, you'd expect our yield to be a little less given the amount of growth that we're producing. Right now, we were actually producing inline yield because we've seen a lot of great valuations, companies that have just been pummeled, and there's become a disconnect between their fundamentals and the price of the stocks. We see a lot of upside potential in some of the higher yielding names within the MLP space that won't cut their distributions, that are coming through the storm and will survive, and investors have mispriced the stocks recently. So we have a little higher yield this quarter than you would expect throughout the market cycle. Our core income strategy year-over-year distribution growth, again, this is just showing a comparison between the MLP universe, which has been hurt by commodity MLPs, which have a lot of them, again, different business model, not leasing. It's only 10% of the asset class have cut distributions. Significantly, almost half of them have cut distributions in the most recent quarter on a year-over-year basis. Infrastructure MLPs, again, as I stated earlier, have grown their distributions at 9.7%, our strategy at 13.1%, so 1.35 times greater distribution growth. And a wonderful way of looking at total return potential is take your current income or your yield on the portfolio or on the underlying MLP, add to it the distribution growth of 13.1%, and it gives you a back-of-the-envelope total return potential of what these assets could produce without any what we call multiple expansions. So it gives you an indication and, again, supports where the portfolio is relative to where MLPs were and the returns that were produced from the trough of 2008 and the Great Recession. So historical performance on Yorkville's MLP core income strategy, the 5-year annualized return numbers on the bottom, and what's incredible about this, because it's numbers that are coming out at the trough of the market downturn. So an investor who's been with us for 5 years, at the worst point, we're probably marking the low again in February. You're still up 5.3% per annum. The Alarian index is down 0.6 of a percentage point over that time. So clearly, and we firmly believe this is an asset class that lends itself to stock picking, and there's the ability to generate alpha in it over long periods of time. As you can see in our 1-year numbers, we've actually underperformed the index quite significantly. The higher quality, faster growing names have not been the ones to perform as well coming off of the bottom here, and that's led to underperformance in our portfolio relative to the index. But still, we've managed to deliver almost 600 basis points per year of additional alpha and more importantly, positive performance relative to negative performance. So I really am finished with our formal comments at this point, and I'm sure there's lots of questions because this has been a pretty hairy ride over the past couple of years, and I'd like to turn it back to Will. Thank you all for listening to our comments, joining the call today, and Will, will you please open it up for questions?
Sure, Dan. Thank you for the informative presentation. As Darren mentioned, with that, we'll now turn it over to the Q&A portion of this call. As a reminder, if you missed the very beginning, if you have any questions, please feel free to type them into the text box in the bottom right corner of your screen, as some of you already have done. So with that, why don't we get started? Jim, maybe give Darren a breather. How do you get comfortable with the integrity of the long-term contracts? Are we at all worried about mass renegotiations in the infrastructure space?
Well, it's a good question, and I think it all depends on where you are as far as investing in the infrastructure area. Clearly, there's been a couple of cases, one down in Texas, where the judge ruled that they were going to renegotiate, but this was really specifically what we're talking about are the GMP MLPs, the gatherers and processors. We have tried to eschew those, investments, and we're sticking, primarily with the higher quality MLPs that, don't face this problem. So, yes, the renegotiation could be a problem with some MLPs, but I think if you pick and choose where you're investing, I think this is a very, very minor problem.
No, that's a good point, and I think a lot of management teams on their call last quarter, and we'll see if they say it again this quarter, has made a point to discuss the quality of their counterparties, many of them with 80–90% investment-grade counterparties. On top of that, we've seen the banks give somewhat of a pass to some of even the more leveraged EMPs in terms of cutting back on their borrowing base. So some will live to fight another day.
And, I'd like to add, if you just look at the asset class, we haven't seen wholesale renegotiation of contracts. The investors have picked up on a couple of examples, some relatively high-profile cases. None of them have been precedent-setting. All of them have been very specific. One of them, the case out of New York, based on Texas, wasn't even, it was very strange in the wording of the ruling. So there haven't been wholesale renegotiations. So the integrity of the contracts, we haven't seen them historically. in an asset class that's been around since the mid-'80s. We haven't seen them now, but there is one thing. As a firm, we have been involved in more meetings with more law firms looking at the integrity of the contracts. There's been more focus on counterparty risk this downturn than at any other point in time in our investment career in the MLP asset class.
And bear in mind also that a company that's in bankruptcy, the judge overseeing this, he doesn't want to impose a renegotiation on a pipeline, an MLP, that is going to be so onerous that that the MLP, isn't going to be making the pipeline isn't going to be making any money on it. So there's a give and take in these negotiations, and it's not just a one-sided arrangement where the distressed company is going to dictate terms. There's going to be some give and take. So I think there, it's something. It's a good question, but I think it's something that is not quite as dire as some people have made it out to be.
And the takeaway that we have from a legal perspective in a company that is either being restructured or in bankruptcy, the two questions and the criteria are this: is it in the best interest of the bondholders what is going on? So generally it is in the best interest of the bondholders to keep the molecules flowing, which means to continue to use the existing pipes to move product from the wellhead. So that's number one, which means if you're going to use the infrastructure, you have to pay for it. Then the second question is are the existing contracts at market rate? So if it's in the best interest of the bondholders to keep the molecules flowing, which generally it is, it's cash flow, then are the contracts at market rate? And generally speaking, these are sophisticated counterparties that enter into these contracts that are very knowledgeable about market rates and contracts. So most of the time, and it's not always, but most of the time, contracts are entered into at market rate. And then finally, a lot of the contracts are FERC regulated. So, which is clearly if it's FERC regulated, it is at a federal rate, which is a regulated rate.
Great, thank you, Jim and Darren. Darren, I'll open this one up to you to start at least. Why have infrastructure, and it's kind of really talking to pretty much a lot of what we've discussed here today, why have infrastructure MLPs been so tied from a price perspective to the collapse of oil, do you think, when volumes had been, at high levels, storage and terminal utilization had been so high? Any way to reconcile that difference from a logical perspective?
Well, I think that it's not logical. This is sentiment, and sentiment is driven by human emotion, and human emotion at the two extremes are driven by fear and greed. And what we have, and this is the markets overshoot because of the human involvement, right? And that's also why, if I had to make one case why markets aren't efficient, is because there's a human element involved in it that is based on emotion or sentiment. And this is not unusual to MLPs. Once there is a run on an asset class and investors get fearful, it's really hard to stop the momentum from going down, and the care and the look at fundamentals goes away. And to a large degree, at that point, even if you are an investor that's looking at it rationally, you're going to wait for sentiment to change before you're going to step in front and start buying, because why do you want to buy high only to see the price go down later? So even if you recognize the fundamentals are strong, you're going to wait. It's one of the things that we have been talking to our investors, and what we learned from 2008 is when we looked back and did an analysis on the portfolio, again, 100% of our names maintained or increased distributions in the worst financial crisis and economic crisis that any of us will hopefully ever live through. And that put in place for us this idea of, if we're generating fundamental alpha, we can find a well-diversified, a minimum of 15 securities diversified portfolio will remain fully invested, because the income, the integrity of the income isn't being compromised. And that's what we delivered again in this most recent downturn. And as long as the income is there, and that's where the stability score and the growth score come in, then overall the earnings power of the assets hasn't been compromised. All right? So if the earnings power hasn't been compromised, the valuation will ultimately come back to where it should trade. So there's no logic to reconcile the two, because there's no fundamental correlation between commodity price and MLPs.
Yeah, I would just like to add, to follow up on Darren's remarks. I think there was, and maybe still is, a misconception that all MLPs are the same, and we certainly have learned. I mean, I'd like to think we knew that, but I think that the market did not. And for example, in the E&P area of the MLPs, of MLPs, clearly some of these companies shouldn't have been public in retrospect. And if they were, they should have been variable, their payouts. But you compare the E&Ps, many of which, as I said, should not have been public, with the midstream, which is where we are focused and where we're invested, and it's the difference between night and day. So I think, as Darren said, that everyone kind of lumped everything together on the downside, and it had a really deleterious effect on the performance of the midstream, and it was way overshot on the downside.
Great, thank you both. I think it leads nicely into another question that's actually been asked by a few of the participants on the call. Given that, Darren, in your discussion about how the oil market gets back into supply and demand, and the fact that the U.S. is going to be where the production is coming offline, how do we as investors get comfortable with investing in the pipelines that they're going to move the product through?
Jim's touched on that a little bit already, and that is not all MLPs are created equally. So it's not only the difference between commodity MLPs, which represent a small percentage, again, 10% of the asset class, 90% are infrastructure. Within infrastructure, there's 5 different sectors. And so the infrastructure sectors do one of 2 things. They'll either move production from the wellhead, well, they do one thing. They move production from the wellhead to the end user of oil and natural gas. So what has been suffering in the U.S. is the supply side is coming down. So you will have individual partnerships, basically gatherers and processors who are the closest to the wellhead, that are going to be in fields, in areas that it's very expensive. These are the most expensive fields to drill for oil or for natural gas, and I guarantee you production levels are going to come down there fastest, and you've seen that with rig counts, and are going to come back on last, because they're going to need higher oil prices and higher natural gas prices. So those are gatherers and processors. What hasn't suffered in this country, and what has actually been growing, demand. So if you remove that one sector out of the 5, you have 4 more sectors that are really responsible for the demand side of the equation, which, again, demand for energy in this country is extremely robust. And so MLPs that are on the other side of the equation, meaning the demand for oil and natural gas, are really agnostic to whether the source is from a field in the United States or coming from Saudi Arabia. And so they're just going to move volumes through their pipelines, number one. And number two, and that's I think I'm going to stop there. That is really, more than anything, how the dynamics of this infrastructure works, which is not too dissimilar to what goes on with electricity generation either. So
no, I think it's a great point. I mean, you look at MLPs that are solely involved in transportation of refined products or natural gas, and they've been looped into the decline in oil prices for no apparent reason other than they have the label MLP tied to them. So I think that's a great point. Switching gears a little bit here, Jim, what do you think about the potential for MLPs doing roll-ups, i.e. the KMI, KMP roll-up from, I guess, back now 2014?
I think the KMI, KMP situation was unique. KMPs was in the high splits for a number of years, and its cost of capital was high, quite high. Not that they couldn't continue to, fund projects, but it was getting more and more difficult. I mean, for those of you that are familiar with the nuts and bolts of MLPs, most MLPs have a general partner, and it's in the interest of the general partner to increase the distributions of the MLP that they're sponsoring. And as they continue to increase them through something called the IDRs, incentive distribution rights, the GP gets more and more of the income, where it usually tops out at a 50-50 split at the marginal level. As far as KMP and KMI are concerned, it looked like it was the best thing to do was to have KMI take over KMP, and I think this was a unique situation. I think that will it happen again? Yes, it's happened a couple of other times, but recently Targa was one, where it happened. But I don't think you're going to see a wholesale roll-up of the general partners taking out the companies, the partnerships that they're sponsoring.
Yeah, I think it's great. Those great points. And in addition to the fact that you have the cost of capital potential issue at the LP, you also, in a more normalized environment, have a tremendous amount of value that is assigned to the general partner. You can keep that as a public, independent vehicle. They really have some high multiples that are assigned to them in a more normalized environment. Moving on, I think we'll just have a couple more questions here before we wrap up. How do we get comfortable with MLPs being able to fund future capital expenditures, given the fact that the high yield energy market has kind of really dried up, and not too much in the way of equity offerings apart from a handful of select MLPs?
So
I can touch on it to start if we don't mind. So I think what we've seen to date has been a lot of creative financing via private preferred issuance. We've seen a number of private equity firms step in for coupons that can make the financing work for the MLP, but at the same time provide a return to the investor that's attractive. So we've seen that as one way. Another way that we've seen financing work is really low multiples on drop downs. So where you have a strategic, or in some cases even a financial sponsor, that it's in their best interest to see the long-term value of the MLP sustain and continue to have it as a vehicle for acquisitions. We've seen lower multiples than what you'd see in a normalized or maybe even a distressed environment on some assets. So those have been a couple of ways. And then on top of that, we have started to see the high yield markets open up in the case of Enterprise and Sunoco pricing deals, one on the investment grade side, one on the high yield side this year, as well as some equity offerings from those top tier players. So I think there are options out there to play to different MLPs.
Yeah, I want just to put another point on Will and the drop downs. I mean, they have been selling assets, the GP at lower multiples, and they'll often for a period of time, a year or 18 months, forgive the IDR payments or on that particular asset drop down. So I think there are ways. I mean, the people that run these partnerships are very smart and creative in a good way, and I think they've found ways, as Will has mentioned, to get around the tough fundraising environment.
Thanks, Jim. I think that'll be it in terms of questions for today's call. Please feel free to reach out with us via email or with a phone call if you have any further questions on the space or our strategy in more detail. But just want to thank everyone for joining us on today's call, particularly those of you who had to sit through some silence on last week's call due to some unexpected technical difficulties. But just as a reminder, replay of the webinar will be available in the coming days on the website. So thank you all again for joining us, and we'll see you next quarter.